Hi everyone, I'm Paul and welcome to my review of Lesson 19 of ICT's 2022 Mentorship. Episode 19 was a really long one, it was about 2 hours. So what I've tried to do is distill down all the charting content into the most essential concepts for you so you've got them in one neat video. I still highly recommend that you check out ICT's video and watch it in its entirety because there's a ton of information there, especially for new traders, but also for some of us older traders as well, to remind us of some of those, life lessons in trading that we sometimes have to learn the hard way. But before we start today's video, please make sure you like this video if you enjoy it, because that helps other people to find it. And if you haven't already, make sure you subscribe to my channel and turn on notifications so that you never miss an update. Now, let's jump into today's video. So today's video is Lesson 19 of ICT's 2022 YouTube Mentorship Program. And as always, we'll go through a quick outline of today's video. So the first section is going to be understanding correlation, because we talk about some correlated assets in today's video. And then we're going to go through the trading concepts with some examples that ICT used in Lesson 19. So that's using the Dixie or the DXY, the Euro US dollar, and the S&P or the ES. And so we're going to cover those on different time frames. So you see we're going to cover ICT's concepts across different asset classes and different time frames, and that's because these concepts work across multiple assets and multiple time frames. So the first section we're going to go through is understanding correlation. So correlation can be either positive or negative, and so in this example we're talking about assets that are either positively correlated to each other or negatively correlated to each other. Now, a positive correlation means the two assets will move together and in the same direction. And a negative correlation means that the two assets will move in the opposite direction to each other. Now, traders can obviously use this concept of correlation to their advantage to either look for confluence, so assets moving together, or divergence, meaning assets moving apart from each other. Now, correlation is a spectrum, so you have a spectrum of a high correlation down to a low correlation. Obviously, the higher the correlation, the more powerful that relationship, and the lower the correlation, the weaker that relationship. Now, correlation isn't static. It's not something that stays the same over time. You might find assets that move, up and down in terms of correlation to each other. And one of the almost market memes you have in crypto is the correlation between the S&P and, say, Bitcoin. So they're quite highly correlated assets, but that correlation has moved over time, and there's this constant conversation about that correlation breaking. So I don't think that's probably ever going to happen, but we'll see. Because they're both basically risk assets, they're very highly correlated, and I see that relationship staying that way for a long period of time. So the first chart we'll start on for today's video is the Dixie or the DXY, which is the US dollar index. Now, the Dixie is looking quite strong, and ICT talks about how he's bullish on the dollar in this video. Now, at the time of the video, it's been up to 101 and it's pulled back to about $100. Now, at the time of this video, the Dixie is currently trading at just under $113, but it's been as high as about $115. So ICT's prediction for the Dixie was correct. It was going to keep going up. But in the video, what he talks about is that the Dixie's gone up to this 101 number, which is, what he calls an institutional level or an institutional number before it sells off. Now, one of the things that he talks about giving him an inkling that the dollar will go higher is that we have these relative equal highs here, which are formed on both of these daily candles, and that, this formation is a bit suspicious. And so there's the anticipation that this will be run in the future, and that obviously if that happens, you're going to get higher prices. Now, that's obviously at this point just a theory, and what invalidates that theory is the possibility of breaking these relative equal lows down here. So, you have these two, counterpoints. You have this overall hypothesis that the market is going to go up, and that is reinforced by the relative equal highs, the buy side liquidity resting up here at 101, and it's invalidated if the market goes below, this 97.75 level, where you have these relative equal lows, sell side liquidity down here. Now we've zoomed into our 1 hour chart, and what you can see is we have this move down from about 99.60 all the way up to 101, and you can really see how clear these relative equal highs are here at 101. And ICT talks about this being almost engineered to trick the market into thinking that the dollar has reached its zenith, it's reached its highs, and it's going to pull back from here. So with our range from here to here, if we run our fib from the bottom of the range to the top of that range, we get our 50% mark, or our equilibrium. So we'd have an expectation that the market is going to pull back and consolidate to that level after it's had a run. And so you can see what happens after we run up to these relative equal highs here at 101. Again, that's this institutional price level that ICT talks about. You can see we have this final candle here, which is just slightly higher than the others. So all of those stops are taken out. So all of that buy side liquidity is taken out by this final candle here. And you can see the market trades immediately lower, and it breaks market structure here. So we have this break in market structure here, which I've shown with this orange line, and you can see the market trades back up. In the process of breaking market structure, we get this acceleration, so we get this displacement that ICT talks about a lot, and in that process we get fair value gaps forming. So we have one here and one here. And so the question often is, which fair value gap do I use? Now what ICT teaches, and this is certainly reinforced by my experience in practice, is that you should use the lowest one, but your risk management should account for the higher one. So we go to enter on this particular fair value gap, but we should expect that price can go up into this level here. So if we just sort of spell that out very clearly, our fair value gap is our 3 candle formation, so 1, 2, and 3, and our fair value gap is formed between the high of that third candle and the low of the first candle. And so that gives us our fair value gap here. Now, if we were going to compensate for the additional fair value gap, which is obviously here, then you would have your stop at the high of that candle, or you could even use this swing high up here. Now in this instance, if we were actually going to take a trade on this particular setup, so if we're going to trade the dollar, you would put your limit order here at the high of that third candle, and you would have your stop at the high of the first candle here. So that's going to give you protection against a run up into this particular fair value gap that's sitting above our entry fair value gap. But again, depending on your risk tolerance and just how much you've tested a lot of these concepts, you'll get a feeling for when you need to have a little bit more buffer, and you could potentially use that swing high there. So if we set that up here, this is what it would look like. We would have our stop there, so you can see our limit would be here, our stop would be here. Now you don't have to use a limit order obviously to enter in the fair value gap. You can use a market order, but that necessitates you sitting there ready to hit the market. So I just find the limit orders is a less stressful way to do it, and it allows me to be much more precise about my position sizing. So in terms of managing my risk, I know that the distance between my limit and my stop is a certain amount, and I can then translate that into a dollar figure so that my position sizing is always consistent. So I think that's really important. The other thing we're going to be doing is obviously setting our target. And we talked earlier that we have the expectation that price will come back to this equilibrium level, and so we can set our target accordingly. That also coincides with the sell side liquidity that would be resting below these lows here, and you can see we've got a bit of a gap here, so some inefficiency. So we'd be expecting that price, if it goes in our direction, is going to fill those in, and that's going to help us to get our fill. So you can see in this instance, if we'd done that, that would have given us a 2R return, which is obviously a great return. And if you'd had a higher risk tolerance, that's obviously going to reduce your R value, but you're going to get about a 1.5R return on that particular trade if you took the fair value gap setup on the 1 hour chart. Now, the good thing about that, you can see you would have entered on one of these candles here, and so you're really only in that trade for about 4 hours. So that's a pretty good return for such a short time horizon. Now, if we zoom in even closer down to our 15-minute chart, we can just see a little bit more information. So if we just run through, the lay of the land, if you like, for the chart. So this is that range that we outlined on the 1 hour chart. So from the lows down here at 99.60 up to the highs up here at 101. And you can see we still have the break-in market structure that we talked about on the 1 hour chart. It's obviously just a little bit more granular. You can see we have this big displacement down, and this is our fair value gap from the 1 hour chart overlaid onto the 15-minute chart. Now, the additional detail we have on our 15-minute chart is this order block here. So the order block is these consecutive up-close candles, so you can just see them just here, and that gives us a bearish order block. So we have the market trade up into those if we were going to trade on the 15-minute time frame, and you can see we get this immediate reaction downwards afterwards, and that's obviously a similar setup to what we had on the 1 hour chart with our bearish fair value gap. Now, the difference with an order block, in this case a bearish order block, is we have these consecutive up close candles, and the way we frame those out is we can use the low of that candle or the open of that candle, and I just generally mark out the whole thing using the wick, and that's the order block that I use. So all of them combined, so the wicks of all of those candles. Now, the important thing to remember about your order blocks, and ICT is releasing more information about order blocks over the sequence of the mentorship, so I'm just adding these in as much as that information comes out, is that these order blocks represent a change in the state of delivery. So they're kind of like a reference point where the market will at some point come back to. So it's sort of like turning the page on your book and you're going to come back to that at some point in time. That's the analogy that ICT uses in his video. Now, the important thing to remember is that the order block is always associated with a fair value gap. So you can see we have the fair value gap here again on the 15-minute chart, and so our order block is right with that. And this is one of the key things that was certainly missing when I learned about order blocks for the first time, was this association with the fair value gap. So if you are going to use an order block, make sure that they are, consecutive candles, either up close or down close, and then you're always going to have them associated with either a bearish or a bullish fair value gap. And as I said, they're associated with a change in the delivery in the market, and they're a reference point that price is going to come back to. So you can see in this example, if we were going to use the order block as a mechanism of entry, it would look something like this. Now, again, same with the fair value gap. You could be trading this at market or using a limit, and this is just a personal preference thing. Again, for myself, I like to use limit orders because that allows me to control my position sizing more precisely. And the way we would do that is we use the low or the open of the first candle in this instance, and then we have our stop at the top of the highest wick. So in this case, it's going to be on that first candle again. And similar to on the 1 hour chart, we're targeting a reversion back to that 50% level, to that equilibrium. And you can see, obviously, given we're on a lower time frame with a much tighter risk, we're going to get a more significant risk reward. And there you go, you get over a 10R return, which is pretty amazing. And you can see we're only in that trade for a very short period of time. So it's 1, 2, 3, 5, 6, 7, 8, call it 10 candles, so 150 minutes, so it's not very long. Now, the thing to remember from these trade setups that we're using on the Dixie is that if you remember back to the daily chart, we were talking about our bias being bullish. So we actually have a bullish bias, but we're taking bearish setup. So we're trading counter trend. And the thing to be really, cognizant of when you're trading counter trend is that more often than not, you could get chopped up. You could get the trade go against you quite quickly. So if you are going to trade counter trend, it's always a good idea to be nimble, to have your exposures quite low, and you might want to adjust, the amount of risk you put on each trade. So if you're trading, 2%, you might want to go, say, to 1%. This is all going to come down to, what you discover in your back testing when you're implementing your model. You should start to see these sort of things, but it's something that you should keep in mind. So if you're trading against your bias, especially if you're very confident of your bias, like in the Dixie, it's got a very strong bullish trend. If you're trading against that, you have to be very careful, and so it pays to be nimble. And if you're always trading against the trend, that is a difficult way to trade in general. So it's just something to keep in mind with these particular setups. So the next chart we're going to look at today is the euro, or the euro US dollar. Now, the thing to keep in mind about this particular currency pair is that it's obviously denominated in the US dollar, so that's why it's euro USD. And also the Dixie is actually made up about 58% of the euro. So going back to the beginning of the video when we were talking about correlation, is that there's actually a negative correlation between the euro and the Dixie. And so obviously, before we even look at the chart, because we have a bullish bias on the Dixie, we should have a bearish bias on the euro, and that's obviously what we have. But there's a little bit more finesse to that, and we'll go through that in just a moment. Now, if we're looking at the euro now, we're on the daily chart, and if we zoom out, you can see that the trend is clearly bearish. The market's been, going from the top left hand of the screen to the bottom right, so it's clearly bearish. Now, if we zoom in a little bit closer, you can see in this run here, the market's traded down. We've created this swing low here where we have our sell side liquidity. Now, the market has traded higher. It's retreated back again. We've taken out this buy side liquidity, these relative equal highs here. The market's traded through that, and we've painted this swing high pattern here before the market has then collapsed downwards towards this sell side liquidity. You can see we've broken market structure just there. We've traded through that sell side liquidity here. You can see we traded through it once, twice, 3, 4, 5 times. And then, as you'd expect, the market has then reacted to taking that liquidity and is now coming back in the other direction. So the thing to keep in mind, this is what I talk about in terms of the finesse, is our overall view of the euro is bearish. But in this very short term, because we've taken out this sell side liquidity, our expectation should be is that we're going to get price going in the other direction, because it's going to be looking for, the next nearest source of liquidity, and that's generally not going to be downwards. It's going to be looking for liquidity to the upside before we start, that downwards trajectory again. So if we zoom into our 1 hour chart now, what we can see is this big downward move, and this was that move on the daily chart, which, took out that sell side liquidity before we had a bit of a consolidation and then that move higher. So if we run our fib from the top of that range to the bottom, that gives us our 50% or our equilibrium level. We've obviously got a discount market down here in that below 50% and a premium market above the 50% level here. Now, in ICT's video, he talks about his OTE, which is a range that's here. Now, I'm not going to go into the OTE in this particular video because that's a whole video in itself. But just the thing to keep in mind is that there's a level at about 60% here, which is what we would use for targeting if we're going to be taking trades down in this discount part of the market, that we'd be targeting up here. So just above our equilibrium level. And so that's a target that we'd use, which is based on that OTE concept. So in terms of my trading, I'll often target that 50% level or a little bit higher, and you can see that that coincides here with this imbalance. So you're looking for price to go into that sort of imbalance level or around that 60% level. So just keep that in mind. That is a difference. I'm not going to go into OTE in this particular part of the video. So you'll recall back from when we were talking about bias in the daily chart, is that whilst we have a overall bearish bias, because we've taken out this sell side liquidity, we have a shorter term bullish bias. And so in this instance, again, we're looking at counter trend trading, so we have to be very nimble, but we're looking at bullish setups because we're expecting high prices in the short term. So on this 1 hour chart, you can see these two setups that I've outlined here. So we have this bullish fair value gap here. So this would obviously be quite an early trade. You can see after we've had this period of consolidation, after we took out this sell side liquidity, you can see the market's traded higher. We've broken market structure there. And so our bullish fair value gap is that 3 candle formation. So 1, 2, and 3. And our bullish fair value gap is across the body of that second candle, and it's between the high of the first candle and the low of that third candle. And you can see the market trades a little bit higher before it pulls back. It just touches it, before we get that reaction, and we trade right up here, and you can see we take out this imbalance here, we go above that 50% level, and we hit about that 60% mark just there. So if we're going to take that as a trade, again, the way you trade this is up to you. You could choose to go in using a limit order at the low of that third candle, or you could be going in at market. Now, with our stop placement, we're going to use the low of the first candle. Now, in this instance, that's quite a good gap. That's going to give us, pretty good risk tolerance in terms of if price goes against us. You can see in this example, we literally just touched the top of that third candle, so we just touched it before we got that market reaction higher. And this is one of the dangers of using a market order, trying to be a little bit too cute, trying to get a slightly better price. You might miss the trade entirely, and you can see how quickly that reaction was here. It was 3 candles, so about 45 minutes, and you would have been out of this trade, and it's about a 2.7R return. So that's a pretty fantastic trade for such a short period of time. And again, still a bullish fair value gap, but we've now had a little bit more, confirmation that our theory is correct, that we're going to get higher prices. You can see we get this slight consolidation here, so this is an order block here, but the market doesn't trade back into it. So if we're using our bullish fair value gap, you can see we have our 3 candle formation here, 1, 2, and 3. And once again, our bullish fair value gap is formed from the high of the first candle and the low of that third candle, so across the body there. And similarly to our first setup, if we have our limit here on the low of that third candle, and we use our stop on actually the second candle, because in this instance, that second candle's low is lower than the first candle. Obviously, we have a shorter range to travel, so if we're targeting, that 60% level, again, not quite as good a return. It's about 1.5, but still pretty good considering, we get there we go in on, say, one of these candles, 2 or 3 candles, again, about 45 minutes. So a pretty good return for a really short time horizon. So if we zoom in a bit closer now and we go into our 15-minute time frame, obviously we're getting a lot more data, and we're going to be able to get a tighter entry on this particular chart. Now, just to run over, what we're looking at, if we just zoom back out a little bit, you can see this is that range that we were talking about on the 1-hour chart. So this is the move that took out that sell side liquidity on the daily chart. You can see we've consolidated. Now, if we zoom back in, you can see we have these 2 moves that we plotted on the 1-hour chart, and you can see there's our bullish fair value gap from the 1-hour chart transposed onto the 15-minute chart. And if you look into that, you can see there's another bullish fair value gap there that's formed on the 15-minute chart. Now, this is often a way that I'll actually choose to trade. I'll overlay my fair value gaps from higher time frames down onto lower time frames, and that just builds a nice area of confluence that if price goes into it. So you can see this dark area that you get more confidence buying at that level because you have confluence of those fair value gaps. Now, in this instance, we didn't have price go back into that. Recall from the 1-hour chart, it literally just touched the top of it. You can see that even more clearly now on the 15-minute chart. It just literally touched into it and then just took off in the other direction. Now, similarly, if we look at that second setup, you can see this is the bullish fair value gap from the 1-hour chart overlaid onto the 15-minute chart. And inside that, and this is a very good example of using multiple fair value gaps to build confluence, is you can see we have bullish fair value gap here on the 15-minute chart. So it's our 1, 2, 3 candle formation. And again, we actually have multiple fair value gaps here. So we're going to use the closest one being this one, but our risk management needs to account for price going into that other fair value gap here. So there's obviously another one here. So in this instance, if we were going to take this particular setup, we would put our limit order at the low of that third candle. So you can see that here. Now, again, you can go in at market, but I'm going to use generally limit orders in my examples. And we would set our stop down here at the first candle, at the low of that first candle. Now you can see that if we again go for that 60% level, which is up here at this buy side liquidity up here, that's going to give us about a 2.5R return, which is pretty great. Now, the other thing you can do if you're concerned about price coming deeper back into this other fair value gap here is you could use the swing low that we have down here on this first candle. That obviously gives you a little bit more room to breathe, but again will reduce your risk return. You're going to get about a 1.6R return, which is still pretty good. Now the thing to keep in mind about this particular setup, and this is what's taught throughout the 2022 mentorship program, is ICT is teaching this New York kill zone. So you can see this is a perfect example of that, using the euro as opposed to index futures. And this is our period from 7 o'clock to 11 o'clock New York time. You can see the setup actually occurs prior to the kill zone, but in that period the price comes back into the kill zone, it reacts against this bullish fair value gap and then trades higher and obviously into that 60% level above that equilibrium that we talked about earlier in the video. But again, just to reaffirm what we talked about when we're talking about the Dixie, is that we're taking bullish setups here when we have an overall bearish bias on the euro. Now that's probably a little bit better in this particular instance because we've taken out that sell side liquidity. We're expecting high prices in the short term after we react to the taking of that liquidity on the daily chart. But again, we still have to be nimble. We have to be aware or cognizant that we're trading against our longer term bias and that the market can move against us quite quickly. So again, it pays to be nimble. It pays to potentially adjust your position sizing and just trade accordingly. So the last chart that we're going to look at in today's video is on the S&P 500 or the ES. Now in ICT's video, so in lesson 19, he actually talks about GBP USD or cable as well. But that section of the video, he doesn't really go through any charting. What he basically talks about is why he's not trading that particular chart just because there's no attractive price action in it. And in that video, he goes through a lot of detail about advice for new traders. So I'm not going to cover any of that here. That's something that you're best to go back to that video and just watch independently. So we're just going to jump to the S&P 500 or the ES, and we're going to look at the most recent price action. So the particular section that we're going to look at is from this swing low to this swing high. So this is our dealing range from here to here, and you can see we have our equilibrium level here. So you can see after the market has taken out this buy side liquidity, these relative equal highs, it's then sold off and it's come back to this equilibrium level, and you can just see here this swing low here, we've just touched just the imbalance between the open of this candle and then the close of that candle. So we've just touched into it and then immediately reacted to the upside afterwards. And so this is what ICT calls his purge and revert. And so what we're doing is we're purging all of the sell side liquidity. So you can see we take out the sell side liquidity here, and then we revert higher, taking out the buy stops as we go up. So you can see if we just zoom in, we've got our sell side liquidity here. So this move takes out that sell side liquidity. So this is the purge that we're talking about. All of those sell stops are purged. And then we have this reversion where the market trades back up into the other direction, and it's fueled by these buy stops. So we've got these buy stops residing on this candle here. And I guess the question is well, why is there buy stops residing on this candle here? And basically what traders will be doing is they'll be trailing their stop. And so if they'd taken a short position up here, as the market's moved in their favor, they'll trail their stop behind them. And obviously if they're short, their stop will be a buy stop at market to close out their position. And so what happens is we get this purge and a revert, and as the market trades higher, it takes out those stops, and that sort of fuels that move higher. Now the question is where will liquidity draw to? So if we look at this area, we have this order block here. So we have this up close candle which is associated with this fair value gap. So we have a gap here in the market. It's only a very small one, but there is a gap there. And as a new trader, we can expect, or the first target, if you like, that we'd be looking at is for price to attack the low of that candle, and then we can anticipate it touching the open And in this instance, what's happened is it's actually hit the mean. So the very center of that order block there is where price has drawn into. And so in terms of this reversion, they're the most likely places that price is going to draw in towards. It's less likely that you will then get price draw into the close or up to the high. And so you'll notice this is quite similar to what we talked about on the euro, where we have a bearish bias. We went into this sell side liquidity, and our expectation is that the market is going to react to that and go to the upside. So in this example, we're using a purge and revert framework. So we're taking out that sell side liquidity on the way down. We then take out the buy side liquidity where these stops are residing here as we come up. And in this example, price is drawing in towards this order block. And in the first instance, we're expecting it to draw to the low, then to the open, and then as a final destination into the mean. So if we zoom into our 1 hour chart now, what we're looking at is that move down, which took out the sell side liquidity, and you can see the market touched into that imbalance that we talked about before consolidating. You can see we come into that New York session. We have our midnight open here. So remember, we're talking about New York time. So this is midnight New York time. The market trades lower. We then have the 8:30 open. The market trades lower again before coming out and taking out this buy side liquidity at these relative equal highs here. Now, one of the really key takeaways from this particular lesson, and I think this is probably where the biggest switch in my thinking had to come from, is that you want to be thinking about where smart money is entering and where they're going to be exiting. And that should be a way that you're structuring your trade. So you're trying to get in, so get into your trade. So if you're trying to go long, you're trying to go long where the smart money will be going long, and you're looking to exit in the same place that they are. So in this example, the market comes down, it takes out this sell side liquidity. So it's attacking the sell stops, which are residing below this particular low here. And so that's creating a whole bunch of sell at market orders, which creates this pool of liquidity for smart money to come in and use as a source for their buy orders. So they're opposing those sell orders in the market at this zone. And then as the price drifts upwards and it takes out these buy stops, these relative equal highs up here, it's the reverse that's happening again. So you have all of the buy stops, which are triggered as price comes up, and that generates then the liquidity for smart money to exit there, because they're long here and they're coming up here. They need to sell, so they need buyers on the opposite side. So they have these stops which all get run. That creates that liquidity pool for them to sell into, because there's just a sea of buy orders there. So I think this is probably one of the most important points of the whole video. And if you can switch your thinking around to, entering with smart money, using that liquidity as your entry method, and then equally on the way out, you're looking at where is the liquidity going to go, where is it going to be generated as your means of exiting your trade as well. So I think that's probably one of the most important points of the whole video, and it's a really critical, switch to flip in your mind about how you approach your trading, and particularly your setups in terms of entry and exit. So if we zoom in again now to our 15-minute chart, we obviously just have more information, and we've got some more detail about this particular segment of the price action that we've been analysing. So you can see this is this period after we came into that imbalance. We've already taken out the sell side liquidity. We've got our dealing range from here to here. Now this is all quite choppy as we go into the beginning of the session. We have our midnight open New York time just here, and we draw that out. And then we have our open at 8:30 New York time just here, and again we draw that out. And you can see we have our New York kill zone between 7 and 11, and so this is the area that we want to be doing business. This is the time in the day that we want to be focusing on. And if we look to the left, looking specifically at our dealing range, you can see we're in the discount part of that dealing range. So that's where we want to be. So remember, we have a bullish bias going into this session because we've had our purge and revert. We've taken out the sell side liquidity. We're expecting higher prices. We are looking for the market to trade up into that order block. And this is all about ICT's power of 3. So we have our Judah swing. We're expecting higher prices, but what we are looking for is for the market to make, either the low of the day or a significant low, which is then going to go upwards. So that's our accumulation manipulation, and then distribution. So this is the accumulation phase. We have the market trade lower. There's accumulation at the lows here. We're going to have manipulation and then distribution up at the high. So we don't have to worry about picking where the close will be. We're just trying to get the direction right and obviously be entering the market with smart money. So in this particular example, we have a really good example of the Judas swing, and we're actually in a really deep discount because not only are we below the midnight open, but we're actually below the 8:30 open as well. So this is a really deep discount. So this is a really good example of that Judas swing. And in terms of, for most market participants, they would see this as weakness because we're below both the midnight open and the 8:30 open. So that would be seen as a sign of weakness. And most traders would be expecting then that the market is going to go downwards, not go up. Now we've zoomed into our 5-minute chart. Now I'm actually using a screenshot for this particular example because my data unfortunately doesn't go back far enough. But what I will do is mark up the chart as we talk about it as we go along. So effectively what we've done, we've gone down to a 5-minute time frame. We have our midnight open just here. We have our 8:30 open here. Just remember, again, we're talking about New York time. And so this is right inside our ICT kill zone. So that's between 7 and 11. So this is right the area that we want to be doing business. Now, what you can see is prior to that 8:30 open, we have this bullish fair value gap which forms here. So that's our 3 candle formation here, 1, 2, and 3. And if we extend that out in time, you can just see how perfectly the market after the 8:30 open trades back. It tags that fair value gap and then immediately reacts to it, trading to the upside. So again, if we were going to enter this position, we would have our limit order just here, which would be at the low of that 3rd candle. So we've got our 1, 2, 3 candle formation, and we would have our stop down here. And so the thing to remember from this particular setup is we're trying to target the low-hanging fruit. So whilst that dealing range is sitting up here, we could easily just be looking for that easy trade, that low-hanging fruit, by targeting these relative equal highs that we have, residing up here. So you could have your exit up here, and that's, going to be enough. You're going to get easily, a couple of R off this particular trade. I don't have my trade tool to figure it out, but you'd have to think that that's probably a 3R trade right there, which is most definitely going to be enough. Now, if you were going to hold for the entirety of the dealing range, and you may choose, for example, to take, a partial, say at this level here, once we've taken out these relative equal highs here, and then ride the balance to the top of the dealing range. But you can see what happened is as the day went on, the market traded higher. We then had a consolidation in the middle part of the day. The market then pulled back, and you can see this level here has taken out then all of these stops that formed over the lunch period and sort of that midday period before the market then went again, and you can see that's when it hit the top of that dealing range here. And so that's what we were talking about before. The smart money has gotten in down here, and then it's exiting down here. And so in terms of taking this trade, we're following that smart money in, and we're then following it on the way out as well. Now, if we zoom in even further to our 1-minute chart, you can just see this creates a lot more opportunity, or more opportunities, to get in on this particular move. So this is that original one that we talked about on the 5-minute time frame, where we come back and we trade into that bullish fair value gap which formed before the 8:30 open. But you can see that once we go through and we tag there, and then the market starts to trade higher, there's other opportunities that appear to us because we're obviously on a lower time frame and price is fractal. So we're going to get our same setups we're getting on the higher time frames down on this lower time frame as well. So you can see that gives us another opportunity just here. So we have this bullish fair value gap that forms here. So you can see the market trades back. We get our bullish fair value gap set up, so our 3 candle formation. You can see that is our fair value gap there. The market then trades back into it. We obviously break market structure just here, trade back into it, trades higher. It actually probably almost touches it again before we run higher. We get again another consolidation before running higher, and you can see we have these imbalances which are forming here. Now again, you could use the imbalance here, so the bullish fair value gap just here, but you would have to accommodate for price to potentially come down into these lower levels here. So you may have to put your stop down here just to have enough room for price to come into that second imbalance before potentially going again. So obviously the great thing about this is if you miss this, very sharp entry down here because you didn't see that there was a setup prior to that 8:30 open, once you can see price is going in the direction of your bias, it's just about zooming in and trying to find those bullish setups and then obviously trading the balance of the range. And so this is really, the cornerstone of ICT's 2022 mentorship model is this fair value gap. So you can see we've taken out the liquidity down here. We've then traded higher. We break market structure. You can see the fair value gap is formed. We trade back into it. The market then moves away. Now in this example, we get a reconsolidation around that midnight open, but we get then another setup from the mentorship model here again, and you can see we trade back into it and then trade away. Thanks for watching my review of lesson 19 of ICT's 2022 mentorship. This was a monster of a video to review, so I hope you found that helpful, and I hope it helped you to consolidate some of your learnings from ICT's lesson. If you did enjoy this video and you did find it helpful, it would be great if you could like it because that helps other people to find it. And if you haven't already, make sure you subscribe to my channel and turn on notifications so that you never miss an update. Thanks for watching, and I hope to see you next time.